Good afternoon, folks. Bill Bodner, Mortgage Market Guide. Thanks for tuning in to our MMG weekly recap. So up on the screen, I have the 10-year note yield, and we're finishing at some of the highest levels in quite some time. And we're going to get into the technicals in a moment. But this week, it's all about the same theme we've been dealing with since November of last year. Fed speak, uh, hawkish rhetoric from the Fed, likelihood of multiple rate hikes, reduction of the balance sheet, and where is inflation going to be? And so the bond market has been essentially in this repricing mode ever since November came about. But over the last couple of months, things have really, since mid-May, rates have really shot up. We went from 166 to a psychological level. Look at that, nearly 3% earlier this week. And then this week, since then, on Wednesday, we've had a couple of interesting speeches, and the one that really took us here at MMG is the one where Jim Bullard on a Thursday said, "The bond market now doesn't look like a safe place to be," and we find that almost as a contrarian indicator, meaning that maybe we're closer to the peak in rates when somebody says that, and wonder if Jim's Bullard is actually long bonds, because it would have been nice to say that when the 10-year note was over here at 130, right? And then say the bond market's not a safe place to be. But after going, the yields doubling on the 10-year note over the course of 5 months probably is less of a fearful place to be than it was back in November. But the Fed is doing a lot of jawboning, and we're getting close to that May 4th meeting when they actually do something. And now what we're seeing because of this week, we have the 2-year note yield moving up higher above, it's near like 275. And that means that the bond market, the short end of the bond market, the 2-year paper, is starting to price in about 10, 25 basis point rate hikes, about 2.5%. And so what we're seeing now in the 10-year note is the yield actually coming down a little bit, even though all this tough talk, because the tough talk is pushing up short-term rates, but the long end of the market is saying, wait a minute, you may not be able to do that much, because when you start seeing yields not go high, it's not worried about inflation, but maybe that there's going to be a slowdown in the economy, which by definition would help alleviate some inflationary pressures. So as we move into next week, a couple of things that we are thinking about at Mortgage Market Guide. Number one, this was a bearish engulfing pattern. And what this means is that the technical chart is kind of fascinating. The way this works is, and this is our system at MMG, right? We dealt with all the fundamentals, all the tough talk. Next week, we're going to get inflation data. Ultimately, the Fed's going to do something. High oil, we talk about that all the time. But then we look at the charts. And so when we look at the charts, at MMG, we use candlesticks because we're looking for reversal signals. When can something change, right? And you're looking for those early signs. And you need a confluence of triggers. And so we got them this week. And so number one, you're looking for a trend. Clearly, the trend is higher in rate, right? So we go higher in rate, and then we get this pattern where you could see, think about the psychology. Prices go up or rates go up. And on Wednesday, after closing at the highs, we open up higher the next day. We go higher still in the yield. We get right to near 3%. And then we close lower than the previous day. And that gives us, what that tells the market is, hang on, this trend may be at risk. And if you're looking as a mortgage professional, housing professional, if you're looking for a trend, you're looking for you want to know when the trend in rates higher is at risk. And we got it this week, right? And what we should take comfort going into the weekend is that you could see here these long wicks. This shows the intraday yield not able to stay near the highs, and it's also beneath this peak. So for our money at Mortgage Market Guide, you need to be watching 3% very carefully. If we go above 3%, it would negate this signal and rates are going to move another leg higher. We're not saying that rates are going to get much better, but what we could do is see, after rates are going higher, maybe at the very least some kind of sideways trading action beneath 3%, and then maybe some relief. We shall see, but it's going to be all about the data and the market digesting all of this crazy Fed rhetoric, because right now it's been a one-sided trade. Remember, the Fed has only hiked rates once, right? And they're actually still buying bonds. So all this tough talk, it's like, okay, well, they haven't done anything yet. We're going to find out in a couple of weeks. So I hope this finds you well. Next week is PCE, which is the Fed's favorite gauge of inflation. that will go a long way to maybe furthering the tough Fed talk, or maybe they back off it a little bit. Have a great weekend. Talk to you soon. Bye for now.